I think from the medium to long-term perspective, things appear pretty attractive. A lot of global and I would say local factors as well coming in sync. Economic activities have bottomed out. Things are improving. Capex cycle is unfolding, and at the same time, we seem to be getting reasonable support, from the investor community as well, which is also quite crucial because it's not always that we find that good economic growth and good corporate earnings growth necessarily delivers good market returns, unless there is positive liquidity momentum as well, and which is the case at this point in time. So, a lot of factors are aligning for Indian markets to do well from the medium to long term perspective. From the near term perspective, there are always some challenges, especially now because the markets have had a decent run, already. Global markets as well, and we seem to be taking some breather. The global yields have hiked, have gone up quite a lot. The Indian yields have also gone up, so to that extent, the risk-free rates have gone up. Also, there are some near-term, things that we need to keep in mind that India's inflation has surprised on the positive in terms of, on the higher side, which is a bit of a negative for the rate-sensitive sectors. So I think from a near-term perspective, maybe from a 3 to 6 month perspective, the market could be range-bound. But if one is looking at a medium-term, 12, 24-month kind of a perspective, maybe longer, things are looking pretty good, I would say.
Okay, things are pretty good for the longer term. By the way, the market is not bad. Actually, the mid-cap index is picking up quite a bit of pace now. And we were talking about how many stocks are trending in the green. PVR, by the way, is sitting at a fresh 52-week high after very strong collections that came in from Gadar 2. So the box office collections have almost hit 400 crores, and that's spiking up PVR right now. And PNB Housing, we just spotted that stock for you. It's up about I think 6-7% as we speak. It's resolved and fully recovered its large corporate NPA to the tune of about 800 odd crores. So that's PNB Housing, 7% higher. Mahesh, thanks for joining in. What do you do with some of the large caps that have fallen quite a bit, right? If you look at SBI, HDFC Bank, even TCS for that matter, these heavyweights are down about 10-12% from the highs that they've seen in the month of July. Is this a time to be accumulating some of these large caps, or do you think you'll get a better opportunity over the next couple of months?
I think the large cap banks definitely appear to be very attractive. I would say they have looked attractive from the valuation standpoint and from the fundamental standpoint as well. In fact, I would highlight banking sector as the only sector which is trading currently at average valuations compared to its history. Most other sectors are trading well above. So from that point of view, it's not just the fundamental, but from the valuation standpoint as well, the banking sector is looking good. The only issue with the sector is over ownership. Most of the large foreign fund houses as well as domestic fund houses seems to be owning a lot of banks already. So that's the only challenge. But yes, I would agree with you. Many of these large private banks, including the PSU banks, appear to be quite attractively positioned in my view. Also, it's a great way to play the capex cycle as well, because we are seeing credit growth holding up quite strong, and that's primarily due to incremental positive trend that we're seeing on the project loan side. So banks definitely yes. On the IT side, I would say it's it would be good to look at it from a near-term tactical standpoint. As I mentioned earlier. Maybe from the near-term perspective, the market could just be range-bound, and maybe from that perspective, IT sector could deliver outperformance here. But I would view it as a near-term tactical buying opportunity, not really something that I would look at least at this point in time, from a longer-term perspective, because the issues in the U.S. economy are still very much there. And while the growth is surprising on the positive for the last couple of quarters, but eventually, I feel that there is going to be an inevitable slowdown, maybe visible in the beginning CY24, late CY23. So I would say IT sector good to look at from a near-term perspective, but it's still not a buy and hold for us from a long-term perspective.
All right. Hi, Mahesh. Good morning. Nigel on this side. Mahesh, I wanted to ask you about these city gas distribution companies. I think you're not very positive on Gujarat Gas. If you'd give us your view out there on the space itself. Price hikes are coming about. You have volumes as well that are picking up a little bit. How do you approach this theme?
Yeah, price hikes are coming through, but I would say at the same time the input prices, are also going up. So when we look at margins, we don't really get a comfort, on the margin perspective. So I would still like to be, on the sidelines on that sector.
Okay, sidelines for that particular sector. Uh, you know, within the entire infra/capital goods story, Mahesh, which sub-segment are you most excited about from here on? Say for example, roads, right? Now that's a more or less a mature kind of sector. The build-out, etc., has happened, and that'll continue to happen. But in terms of incremental, big sort of growth, is it going to be railways, for example? Is it going to be something else? Water, for example? Any new themes within this broad gambit we call, infra? What are you most excited about?
See, if you look at the broader cap goods infra sector, and it's a sector that obviously we've been, very, very positive about, and continue to be positive. I think India, as a whole, has just entered the capex upcycle, and I think it's a cycle that is usually, going to last for at least another 4 or 5 years, in my view. So a lot of stocks in this sector, the cap goods, infra, and I would say the broader capex cycle play, the investment cycle play, are going to deliver excellent returns, in my view. Um, the one thing that we kind of, I wanted to highlight is that when you look at the capex cycle play or the investment cycle play, there is actually a dearth of stock ideas, especially in the large cap names. I mean, there are a couple of large cap names here, but that's it. And then if you want to play the investment upcycle, you really have to go down into the mid cap space. And in the mid cap space, obviously, there are a whole bunch of ideas. And my sense is that different investors are going to take, different view about the various subsegments that you're talking about. But by and large, given the fact that there is a dearth of ideas at the large cap space, I think many of these mid caps and small cap, subsectors will do very well. You mentioned, roads, but I would say, even the contractors, the capital goods, the equipment, makers, defense. So there are a whole bunch, of these, stocks in the mid caps and small cap space, particularly, which should deliver excellent returns, in my view. Maybe from the near-term perspective, as I mentioned, given that the yields have gone up and given that the fact that the inflation has, surprise on the upside, maybe from the near-term perspective, there could be some challenges, but I would actually use any of these dips to buy into these names, all the subsegments, cables, wires, etc. as well. And I would not really get bogged down by what the current P multiples or the current valuations are. Many of these stocks are trading at well above their historical trading ranges. But as I mentioned earlier, we are seeing the capex upcycle in India for the first time in the last, I would say, 12, 15 years. Many investors haven't really seen the capex upcycle in India, and how the stocks typically react in that kind of an environment. So I would not get bogged down by above average valuation seen in multiple subsectors within the broader cap goods infra space.
Okay, got that. I do want to ask you about your own overweights and underweights, but I'll come to that in a bit. Before that, the big event upon us, Mahesh, is the Jio Financial Services listing, right? And the narrative is that it has the potential to disrupt the digital lending landscape in a big way, just by its sheer distribution reach already. And perhaps there could be a consolidation in the sector with smaller players, finding it hard to survive in terms of pricing, etc. Your own thoughts on how this could play out for the industry?
Yeah, so as you know, Sonia, I'll not be able to comment on individual stock, but at a broader industry level, yes, it's a it's a big company that is entering into this space, and my sense is that it is going to take some time for any new company, no matter what kind of muscle power that you're coming with, it is going to take some time for the company to establish itself and show meaningful impact in various subsectors that you mentioned. And I think eventually it will. But my sense also is that Indian financial sector is growing. It is severely underpenetrated at this point in time, and if you take a 5 or 10-year view, I definitely see that there is enough space for more than 2 or 3 large NBFC players to be present in this segment. I mean, we've seen so many large banks, right? So it's not necessary that one large player entering will disrupt the existing companies in a meaningful way. They will obviously have to kind of gear up for sure. But whether I'll just be in a hurry to sell my existing holdings in the NBFC space, the answer is no, because the space itself is growing and existing companies are also innovating.
Okay, thanks very much. It's always a pleasure. Appreciate you joining in, Mahesh, with all of that perspective here on CNBC TV18. Thanks indeed. Well, the market's doing just fine. We're up, 50 points at 19,363. Look at SBFC, Small Business Finance, the listing. It's 4 days old, listed, had a bumper listing. And the high was, about 95, 96. It's drifted a little bit since then, as the markets looked a little, seen a little bit of pullback. So about 86 now on SBFC at this point in time. Well, the Motilal Oswal Annual Conference is kicking off today. It is the 19th Annual Global Investor Conference. And as always, the conference promises to bring together top CEOs, a diverse range of eminent speakers, experts over the next few days here in Mumbai. Well, according to Motilal, we're talking 200 plus companies with 1,000 plus investors from across the globe. Ramdev Agarwal is the driving force behind the research endeavors at Motilal Oswal Financial Services. He's joining us. He's chairman, co-founder at the company. Mr. Agarwal, great to have you with us here. Thank you very much for your time. Appreciate it. I can see the sort of activity starting up behind you. So it's always a very vibrant event. And thank you once again for joining us from the sidelines of it. What are you most excited about, Ramdev, from this conference? What are you hoping to learn from all the companies who are going to be there and all the investors who are going to be there? Because it's a two-way process, right? I mean, they'd want to hear from you and you'll hear from them. What's top of mind for you, really, this morning and over the next couple of days?
Yeah. Good morning, Prashant. I think the mood is set. We are at all-time high, and after a long time, there will be a full participation, because last year was the first year post-COVID. Still, participation a little muted. But this year, I think investors have come in full force, and people are coming from, apart from domestic ones, we are getting the delegates from newer countries like Korea, Taiwan, Japan, apart from usual Hong Kong, Singapore, US, London, those guys, they have been coming in the past, but now we are seeing slew of new countries joining in. So we'll get opportunity to interact with all of them. And even the companies lineup is about 220, 225 companies. So I think it's a big mela for next 3 days. And I'm trying to catch few trends. What's happening in terms of what's happening in the economy on the ground, because all the operators are there. Second is that what is the thinking of FIs in terms of their confidence in India, how do they think, and their allocation, would they like to be still conservative, or would they be, this is 23, 24 will be the year of again coming back into Indian market. So those are the discussions which are going to come, and it will be more in listening mode than too much of asking.
Ramdev, hi, good morning. This is Sonia here, and all the best for the conference. It's very interesting, right, to hear that so many FIIs from new geographies have registered this time around. And if you look at the data that has come into the Indian markets in terms of FII flows as well, FPI flows rather, it's been the highest in India compared to the rest of Asia. So what is the sense that you're getting from the interactions you've had already? Is the interest still as high as what it was in the last 6-8 months? Or is there now a little bit of caution that's kicking in?
Yeah. So, Sonia, very good morning. I think it is too early. I've just come in here to the venue, and through the day and till late night and tomorrow and day after. I think 2-3 days I'll be interacting with all of them, and during the conversation only we can figure out what kind of interest they have. But right now, I would say there is an optimism, and the number of. I'm going by the fact that the kind of a request which is there for the participation and the number of meetings. I think we can do about say 7,000-8,000 meetings effectively, but the request is for 25,000 to 30,000 meetings. So that tells me that investor interest is very high. This is of course mainly domestic demands, but even the foreign demands for the meetings are quite high.
Hi, good morning, Mr. Agarwal. Nigel on this side. A lot of foreign interest as well, but a lot of big HNIs from all across the country as well, have come for this conference. And a lot of them we don't get to meet, but because of the conference, we're going to be catching up with some of them post the conference. But tell us about the interest levels, particularly the mid and the small cap space, because that's been an outperforming index for the last 5 to around 6 months. Is there still big interest out there? And what's your view? Have it run a little bit ahead of itself?
So I think it is to do with the structure of the market. Still the institutional activity, particularly from the FI side, for last a month or so is a little subdued. But we are passing through one of the. In fact, I'm presenting on that India's retail equity revolution. It's nothing less than revolution in what has happened post-COVID and what is happening and what could happen in the next 3-4 years. So we are trying to compile this thing. So the impact of retail equity revolution or demat accounts opening, participation going from 30-40 million to 120, 130 million and trying to become more like 200 million in the years ahead. I would think that interest level will actually become bigger and bigger, and these are counters where with limited floating stock but a lot of buying power. So that tends to distort at some point of time. But eventually the corporate earnings underlying will decide the levels where it will settle.
No, so if I were to, Ramdev, if I were to ask you right now, right, for the small cap space here has been the best performing, in a way, asset class, not just here in India, but maybe around the world. Maybe this year or whatever time period you want to use since the rally began. So where are we? Is that space looking still quite okay to you? You have a sense of history. You've seen this play out many times before. What's your sense? Is it time to take the foot off the pedal a little bit, or fundamentals and earnings there are looking healthy enough to kind of sustain this up move?
Prashant, our biggest problem is that we have seen 40 years of the market. We have seen such low levels of the market. The mid cap, small cap was so neglected. Single digit P was, they were thankful. But today is just the different kind of thing. So many times I'm not able to appreciate the valuations granted to small or mid-sized companies. Of course, they are growing very rapidly. So, that's the kind of thing. But as I said, it is a structural boom from the retail side. And retail is not happy buying HDFC Bank and ICICI Bank. They are happy playing out on more on this mid and small size companies where they have access to the information and they can also size up their bets. So I would think that excitement will continue. Of course, it may shift from one sector to other sector, one company to other company, because no company can keep growing to the sky. But I think you will find a lot of excitement in the small and mid caps, and the names of the companies will keep changing. Today it is defense, tomorrow it could be NBFC, day after it could be some other theme. So whatever themes comes, but I think that sector will remain quite exciting.
No, you started by answering that question by citing retail flows. Now, and that is also a big structural driver now, which was not there even 3, 4, 5 years ago. So that.
Yeah.
But how much of the boom that we're seeing in that part of the market is because of this? And how much of it is driven by? It's a mix, obviously, but I'm just saying, is it retail money chasing some of these stocks up? Because you got to square that off against earnings growth and valuations, etc. So just trying to get a sense from you, Ramdev.
Yeah, so Prashant, what has happened is that in the past, till about say January 20, so this entire phenomenon is just about 3 years old. So before that, the retail participation was extremely muted. Let me give you some number. That number of demat accounts opening every month was about 3 to 4 lakhs, and at best it will go to 5 lakhs. The moment the digital onboarding is started, it shot up to 30 to 40 lakhs. Now the average between 20 and 23 is more like 2.5, 3 million per month. And in between, when the market was correcting, it dipped, and now again it has come back to 2.5, 3 million. So this is very relentless. There is a lot of juice in the number of participants which are going to come in. I mean, you can imagine from 40 million to 130 million, and that going to 250 million. So at least the boom in participation, participants is on. Now, what it will do? See the 2-3 forces coming together. One, increasing number of participants. Second, the increasing disposable income of all these guys. So, and third is the increasing corporate earnings. So when all three come together, and if you look at from the FI side, FI in last 30 years have sold only five times, and last time was the last year. So I would think probabilistically they would not be net seller in a meaningful way for next 2-3 years. So now you have foreigners buying, retail buying, corporate earnings very good. I think you can't get a better picture than this.
Okay, we'll end that on a positive note. Ramdev, all the best for the conference, and thanks a lot for joining us to give us a primer on what to expect from the Motilal Oswal conference. Well, let's move on. The big deal that took place in the last 48 hours was Titan deciding to acquire additional 27.18% stake in CaratLane for 4,624 crore rupees. Do note, this transaction will take Titan's stake in CaratLane to 98.28% on a fully diluted basis. Ashok Sonthalia, the Chief Financial Officer at Titan, joins us now to talk more about that. Mr. Sonthalia, thanks a lot for joining us. First, if you can just tell us what was the rationale behind acquiring this additional stake. Is it because CaratLane is, a fast-growing business? And how do you plan to fund this as well? What could be the way forward in terms of both funding as well as the changes in CaratLane post this deal?
So good morning, Sonia, and good morning to your viewers. Of course, since we acquired first time in 2016, last 6-7 years, CaratLane has come of age and 2,000 crore plus and established itself as a strong omni-channel player targeted at young women consumers and fashion diamond jewelry space very, very strongly. We see from Titan point of view, it's a multi-decadal opportunity of value creation. And that is what the primary motivation for us to kind of increase our stake at this point of time. India is poised for next decade or 2 or 3 from the consumer story point of view. And I believe jewelry segment is also equally going to do well. As far as this deal is concerned, our balance sheet is pretty healthy. We have a good cash position, but we are going to do part debt funding for this deal. And we are working towards that. And by the time deal comes to closure in next 2 months kind of horizon, we should be ready with our financing plan. But part debt funding is contemplated. As far as your third point, CaratLane, of course, after the deal closure, founder Mithun Sancheti will step down, but the current CaratLane team, which is very, very excited, is expected to continue, and then they are going to take forward this value creation journey. Yeah.
All right, Mr. Sonthalia. Well, this is Mangalam here. I just wanted to know, same time last year we were having this conversation whether you will look to increase your stake or not. You said at 72% you are comfortable and it allows you all the control that you have at CaratLane as well. So within 1 year, what happened for you to actually put in like 4,600 crore rupees for just, 21% stake in the company? And you said that it will be part debt, part cash. What is the current cash on your books?
Could be more than 3,000 crore, Mangalam. While, on the ground, we are not changing strategy, and that 72% control was good enough to manage the portfolio and the way we wanted to do that. It is more looking at one stage of value creation and bringing the company to a stage where it is very, very strong omni-channel player. And from here, what value creation opportunity is there? And we being an insider, we can clearly see that. We want to participate at 100% level there. In any case, also, you should appreciate that with an individual and corporate joint venture situation has to see exit at some point of time. And we believe this was the right time for Titan to increase its stake.
So is there any agreement for the remaining 1.7% stake which you haven't bought now? Because after this, your stake will be, close to 98.3 odd percent. That's one. And secondly, what will the margins of this business improve to? It's just 5.5%. You're saying there is strong potential.
Yeah, so, there are several employees who are ESOP holder in the company and who have equally worked hard along with Titan and the founder team to kind of take this company to where it is. So it is only fair that some kind of liquidity they also see and reward they also see. But all these things will be considered only after closure of the transaction. And it is for Titan board and CaratLane board to consider how we want to deal with that 1.7%. The second point which you, what was your second point?
Margins, sir. Margins from around 5.5%. Where do you see it headed?
So, like if you look at EBITDA margin trajectory for last 5 years from up to FY23, almost -9% to +9%, it has happened. CaratLane is largely diamond jewelry business. So the opportunity to keep inching up margin and gradually not only equal Titan jewelry portfolio margin, but be slightly better than that exists. And I think you will see them working towards that.
All right. Hi, Mr. Sontalia. Nigel on this side. First of all, congratulations on this deal. Some part of the street would have expected the stock to be under pressure because of the kind of valuations you have paid. But clearly, they've taken it positively. So let's understand the trajectory from here on. One is on the revenues. It's moved from 700 crores to 2,200 crores odd. What is the growth trajectory you'll be looking at from here? Point number one. And point number two is, since, you've gone ahead and paid top dollar for this, clearly you have a vision, right? So will you look at listing this arm separately at some point of time?
So, they have been growing 50% plus CAGR, but of course, scale impact would expect it to be setting. But we certainly believe that this business still has huge opportunity and huge growth ahead of it. Like we talk about that our jewelry business with respect to jewelry industry in India is current 7% market share and will go towards 10% by FY27. CaratLane similarly within Titan jewelry portfolio sits at about 6-7%, and they should go towards 10% by FY27. So certainly they need to grow, and in our expectation, they will continue to grow faster than rest of the portfolio for foreseeable future. And beyond that, I don't want to give you a specific number at this point of time. As far as the question on merger, etc., is concerned,
no, on listing, sir. On listing the arm separately, Mr. Santalia. Do you have a plan to list it separately at some scale?
No, there is no immediate plan, and I don't think we are even considering listing. We will rather run a portfolio of brands for our jewelry business, and it doesn't make sense to us to have two listed entities in the same space.
Mr. Sontalia, we've got most of the numbers here out, but I just want to understand, you said CaratLane is largely diamond-led, right? Do you do artificial diamonds as well?
No, they don't do. It is all real diamond, natural diamond.
Okay. Globally, the share of artificial diamonds, right, is increasing rapidly. I mean, at least that's what I'm able to gather. How is that a threat at all down the road? I mean, you'd have a better sense than anyone else regarding this, because that would mean much lower margins, etc., if that were to kind of, become widely accepted here in India as well. Your thoughts?
So, Prashant, you would recall that March 22, we made a minority acquisition in a lab-grown diamond company in US. This is, of course, with the intention to keep understanding. US is the, I would say, at the most front of this whole lab-grown diamond industry. And we understand what developments are happening. And you are right to say that lab-grown diamond are, at least in bridal engagement ring, etc., is making good inroad in US market. As far as the India market is concerned, we have not seen. India is more becoming a supply chain center for the lab-grown diamond, but in consumer space still we have not seen much. We rather see, while it could be a slight risk, but we see more than risk that it is an opportunity for bringing many more consumers, so that diamond could be for everyone. You know, you would have heard diamond forever, but diamond for everyone kind of thing can happen. And we will be ready. We are ready with our knowledge. We know how things are progressing in US.
Yeah.
So when Indian consumers are ready for this, we will have our own offering on that.
You'll be ready as well. Well, it's lovely to hear. Thank you very much, Mr. Santalia. It's always a pleasure having you with us here on CNBC TV18. Appreciate your time, as always. That's Titan with their perspective on the sort of deal which they've struck with regards to Carrot Lane. Stock's actually higher. The market's up. It's given up a little bit. It was up 50. We're up about 18 points now, 19,327. We'll take a quick commercial break here. But we have a special chat lined up with Mithun Sancheti, the founder of Carrot Lane, on our show Young Turks. You can catch it right here at 5 p.m. later today, only on CNBC TV18. Well, right now, after the break, we will connect with Sriram Velayudan of IIFL Securities and Prakash Devan and Gurmeet Chadda of Complete Circle to talk about the big listing, Jio Financial Services. Stay tuned. That conversation comes up next. Okay, we'll have Jio Financial Services start trading in about 8 minutes or so. Sriram Velayudan is Vice President, Alternate Research at IIFL Securities. Prakash Devan is joining us. And we also have Gurmeet Chadda, Managing Partner and CIO at Complete Circle Consultants, joining us. Gentlemen, great to have all of you here. Gurmeet, to you first. I mean, your assessment of where this should settle down post the listing. I think that's what we need to kind of focus on here. Any thoughts around this new listing?
Eagerly looking forward to it, Prashant. So there are 2-3 bases to value it. One is, that 6.1% stake, and you have to ascribe some holding company discount to it. Second, it's lendable net worth. If you see, it's about 22,000 crores. If you take the cost value and the other liquid transfer which has happened in the entity, which means for next 2-3 years, it can build a lending book of roughly about $14-15 billion without really having to, dilute anything or raise more capital. And I think it will get a book value similar to what a Bajaj or Chola gets, because it would be more a digital lender, will probably grow at a much faster rate. So I think the current price looks roughly around that. I think you can value it around that. And I think this is probably more new age. So probably you have to look at it more like what Alibaba had or Amazon had. Alibaba had, and obviously the IPO got delayed. And, the way the new age, this is actually more new age if you were to compare it with the more lenders. And I think they're clearly focusing on more consumer lending and MSME to begin with, which is high growth, high margin. But I think it will take time, Prashant. You suddenly don't expect it to become 1 lakh crore AUM. It just has, for example, 30 people in collection. It will take a lot of time to build branches, get that infrastructure in place. Lending is a very different game.
So, Gurmeet, as of now, you don't see any major threat to some of the incumbent players, right? I'm just asking from a from an investor and a stock market angle, how do you approach the other players when such a large, perhaps disruptive player enters the market?
It could be margin dilutive in certain segments. I don't think so they're going to do mortgage immediately. So I don't think so, really banks have too much to, but few NBFCs, it could be margin dilutive in few pockets, let's say micro lab, bit of personal loan on a particular CIBIL score, or used car loans. They could be a little disruptive. Also in consumer durable, they would want to leverage that segment. But the market is too big, Sonia. I mean, that's what I'm saying. They will take probably some time to get to 50,000, 60,000 crore of loan book. So let's say to get to 10, $15 billion, unless they do, inorganic acquisition, which, they are capable of. So I would subscribe to it thinking that this has the potential, right database, huge, very good team they are building. Very impressed with the team. Not only just Hitesh and Mr. Kamath, but I think the team they're trying to build on the ground is very good. So I would be an investor in it, but not from immediate gain perspective. I think it will take time. Lending business takes a lot of time.
All right. Hi, Gurmeet. Good morning. Gurmeet, just to press home the point, so in the near term, well, they'll have to still grow the business. But where do you think the risk will be more at a later date? Because this is a big company coming in there into the financial services space. Everyone's talking about the NBFC space. But do you think the AMC space actually will face a bigger threat because of the brand value that the conglomerate has?
Not really, Nigel. See, BlackRock also came in earlier, and they'll probably be more disruptive on passive side. Not as much as active. Active takes time. You need to build performance over a period of time. There is Bajaj Finserv already, which has just come in, and there are a host of others. So AMC business also takes time to get profitable. In fact, if you see out of 30 odd AMCs, barely 10, 12 are profitable. And probably the top 5 would take about 70-80% of the profit share. So I think all these businesses, they will incubate insurance, asset management, lending. They are backdated. They take time to get profitability. Also, the market would want to see return ratios, right? What the return ratios are. You ascribe 5 to a Bajaj or to 4.1 to a Chola on FY25 on 20-25% return ratios. So that takes time. The collection infrastructure takes time. But as I said, the focus is MSME and consumer lending. It's high margin. And they can grow it really fast, 30-40%. So they will be clubbed with, the new age guys more than the traditional NBFCs.
All right, Gurmeet, I think you have to run. So thank you very much for joining us. Appreciate you sort of joining us on the program. Sriram is with us, and so is Prakash. Sriram, from a near-term perspective, I think some 4,000 crores worth of selling is expected from passive funds.
Yeah, hi, Prashant. Good morning. Yes, you are right. In terms of an impact, Nifty and Sensex benchmark passive funds will be selling aggregated in terms of dollar million. It amounts to roughly $500 million worth of selling in GMNC services that we are likely to see. So in terms of the global indices, MSCI has already decided to JFS as a part of the standard in cap category. So it largely becomes a neutral event because passive buyers who are holding Reliance Industries will be entitled for JFS. With clarity on listing coming into place on Friday, FTSE indices also decided to retain JFS, Geo Financial Services in the FTSE Cap, All World and the other indices. So largely the selling impact is likely to be in the domestic funds. Passive basically.
Okay, got that, Sriram. We just have a little over a minute, I think, before the listing comes through. So Prakash Diwan, let me squeeze this in very quickly. I think the larger question is, can Geo Financial replicate the kind of success that they've seen in the telecom and the retail business, right? Because it's not so easy, as Gurmeet was also telling us earlier. What is your own view on how things could play out?
So absolutely, Sonia. I think financial services, especially when you enter the entire gamut of lending, asset management, insurance, there's lots that needs to be created in terms of the support system, and that is what organically takes time. Once that is in place, I think the kind of scale that they're starting off with will help them reach levels of a book or business that's probably taken much longer for a lot of the competitors to reach. So from that perspective, it's going to be money well spent. Whatever money you spend, the velocity of money, the way it's being used for building this business is going to be far more effective than a lot of other businesses. So I definitely feel for somebody who's wanting to participate in the Indian financialization story, there's no better way than participating in a GFS stock. So, that's what it gives you with clear visibility, though not immediate, not short term, but in the medium to long term, it definitely offers much more than what you would probably buy into some other of the listed names. Of course, there'll always be questions around whether they'll be able to do it well and effectively and all, but I'm sure given their past track record, there's nothing much to doubt.
All right. I think there you go. That's the listing coming through 17 years after the last listing from the Reliance stable. That was back in 2006. I think we've got Jio Financial Services making it to the market at 262 rupees per share, which is exactly at the discovered price, which was 261.85. It's basically around 265 right now. You can see the top team, including Mr. Kamath there, ringing the bell, ringing the stock in into the listed space. And there you go. Just like that, you've got one more stock from the Reliance stable out there in the market listed. Jio Financial Services. So, as I said, it's been almost 2 decades. Reliance Petroleum was the IPO which came through in 2006. And that was the last one from the Reliance stable. And now you've got Jio Financial Services in the market. I think more pictures coming through at this point in time.
Well, big moment there. In fact, we have Jio Financial Services that has listed. And to give you a couple of data points, the market capitalization is around 1.68 lakh crore. It becomes the 32nd most valuable company on the Indian bourses itself in the first minute of listing. So that's one big takeaway out there. 32nd in terms of market capitalization, ranking on market capitalization. And for today, as well as the next few sessions, that's for the next 10 trading sessions, I think, the stock will be in the 5% circuit limit. So just keep that in mind as well.
So, just to actually take that point forward, Nigel, let me ask Sriram. Sriram, the rule says that the stock has got two. By the way, we will cut across two when I think there will be a sort of brief address, I think, maybe an opportunity for questions. So we'll cut across to it. But Sriram, it says for 2 days, it's got to trade 2 days without hitting a circuit, right? So that's today and tomorrow. And then on Wednesday evening, it can be removed from the indices, from the Nifty, etc. So that's the 5% circuit? Is that how this will work?
Correct. Right, Prashant, you are right. So provided it doesn't hit circuit today and tomorrow, it will be deleted from Nifty, Sensex and other.
Oopsie.
Sorry, I think we lost the line there. Sriram, are you there? Okay, I think we lost it.
So just to tell our viewers that currently you have 51 stocks in the Nifty because of this corporate action. But in the next 2 days, if it doesn't hit circuit, Jio Financial Services will make its way out of the Nifty. That's because of the revision in rules that came about by the National Stock Exchange earlier this year itself. And it could possibly make a re-entry. But the re-entry could be at a little later date because first it needs to be eligible to trade in the F&O market. Then it will be followed by a re-entry into the Nifty. So that's the other clause in there, along with the other clause with regard to the average turnover that will be traded along with the market capitalization as well. Market capitalization, it fits the bill, but for it to get into the Nifty, it'll have to, get into the F&O market as well.
Nigel, the last review, the half-yearly review happened, I think, just last week. So the next one, 6 months out, maybe in February or whatever, right? Unless, of course, something else goes out and then they consider, it's happened before. According to eligibility, and the space, it can make its way back. Most surely, I think it will. I think Prakash is still with us. Prakash, first thoughts? We've got a new Reliance stock at about, 251 as we speak?
Yeah, and the first one with the Jio moniker. So, that's more exciting. So, and probably a couple of years back, nobody would have thought that Jio Telecom might not get listed as quickly as Jio Financial Services. So, this is what happens in markets. They're so dynamic. But, also given the fact that apart from this passive selling, selling by the passives, which is likely to be done to adjust their own weightages and all, you'll probably start seeing the stock stabilize in a while before people start allocating actively to the stock, and that's going to be interesting, Prashant. And I think by next Monday, same time, we'll probably be also much more well informed about the plans going ahead and the timelines possibly when Mr. Ambani, addresses the AGM. So that's going to be the key thing. So till then, you probably just kind of let it settle and do its own thing. Yeah.
Also, Prakash, now every time Reliance reports their numbers, you will have a lot more of us sitting there analyzing the numbers, right? We'll have oil and gas, telecom, retail, and now JFS as well. So it's going to be a longer show perhaps. But jokes apart, the larger question, I guess, is, I mean, there will be a broad range of services that they will offer. And now with this listing, they've created the 5th largest financer in terms of capital and a direct contender against, these prominent names like Paytm, Bajaj Finance, etc. One last word from your end. Of course, more details awaited at the AGM. But from this 1.1 lakh crore book, how much do you think the growth can be for them? And what do you do with some of the other players now, the likes of Bajaj Finance, etc., as an investor?
So, I think it's going to be a bit too early to compare JFS with the likes of Bajaj Finance at this point in time. And, even going ahead, Sonia, JFS is likely to be a composite of quite a few things. Whereas, Bajaj Finance is probably only into consumer credit, largely, or you have a Paytm, which is more of a payment bank-led, platform-based lending. Geo could probably do much more than all of these put together. So there's going to be like a sum of parts, and there's going to be, in isolation, some of these focus businesses. So I think as a stock picker, you would be better off buying into Geo Financial Services, because you really don't know which part of the business is likely to do well. So whether a Bajaj Finance has a phase which is very growth oriented, or whether a Paytm makes a comeback. But within Geo Financial Services, you would get lots of other businesses to be thrown in, and that makes it much more balanced. So I think it's going to be the perfect balanced growth vehicle for your exposure to financial services in India, undoubtedly. And to the question on how soon they can kind of leverage this size, I think the book will probably take time, and it's going to be, as I keep on saying, it's going to be much faster than what others have done to reach a certain scale. I would believe they'll probably do what Bajaj Finance has done in a matter of few years. Bajaj has taken a decade and a half of sorts to really grow. Same thing is for the asset management business. They could probably grow very soon, very fast, because of the focus on passive funds. You really don't need much of a head start in terms of performance, track records, and distribution networks and all that. I mean, you leverage on technology, leverage on your database, and that's how you grow. So all these businesses are going to be fast growth areas, very promising, very balanced. It's definitely something which people should take advantage of.
Okay, Prakash, thanks a lot for joining in. And that's the big headline right now. Geo Financial Services has finally debuted on the stock markets, creating the 5th largest financer in terms of capital. Let's slip into a quick break now. On the other side, Mitesh Thakkar joins in for some technical trades. Stay tuned. Welcome back to Bazaar Morning Call. It's absolutely flat for the market, so not too much on the headline index, but there are plenty of individual stocks that are moving around. Adani Group stocks are coming back, so just keep an eye out on them. Adani Enterprises, Adani Ports, all in the green right now. But Mitesh Thakkar is joining in. Mitesh, any interesting stocks on your radar? Something that, you can take as a positional trade on the upside through the course of the week, perhaps?
Yeah, good morning again. So I think, very clearly the market isn't going anywhere, but there is some action happening on the stock side. And one can look at Dixon Technologies. I think it was a move a couple of days back. Is again trying to break out on the hourly chart. So I would recommend buying here. Keep a stop at about levels of 47.70. Look for targets of around 49.40, 49.50 on the upside to begin with. And the other stock, which possibly is giving some reversal on the intraday charts, is Axis Bank. Keep a stop below 940. Look for targets of 960.
All right, Mitesh, thanks a lot for that. Let's do one thing. Let's slip into a quick break on that note. On the other side, our special segment is the economy. Lata will get chatting with Steve Englander of Standard Chartered and Robert Sokin of Citi to talk about the significant jump that we've seen in US yields. Stay tuned.
Welcome to It's the Economy. The US dollar is the reserve currency, and hence the US 10-year yield is going to be the default interest rate of the world. Now, the rise in the US yields from 3.5% in June to 3.75% in July to 4.3% in August is actually impacting macros of all countries, because this is the default rate of the world. Now, what explains the rise in these yields, and will it continue to rise at these levels? Because if it will, then it's going to impact all of us. For these questions on US yields, I'm joined by Robert Sokin, the chief economist at Citibank, the global economist at Citibank, and Steve Englander, head of macros and North America research at Standard Chartered. Good evening to you, gentlemen. Thank you very much for staying up on a Sunday night for us. Well, first, let me come to you, Robert. What has caused such a significant jump in US yields, according to you? Is it Fitch downgrade? Is it just FOMC minutes? Just explain to us.
This is really the critical question that's driving markets right now. So I would point to a range of factors leading yields to rise so significantly over the last month, as you highlighted. The first and foremost would be the resilience of the U.S. economy and the amount of strength that we're seeing at this stage of the cycle. You can point to a wide range of data that highlight that. You know, we've seen continued strong labor market data, strong retail sales figures, strong housing data, and given the amount of rate hikes we've seen in the cycle, if you go back several months ago, we would have expected the economy to slow down a lot more. So it's this ongoing resilience that I think is convincing markets that not only is the economy performing better than expected with these rate hikes, but that might mean that any expectations for rate cuts have to get pushed out further into the future, and it may also be that beyond that, rates have to stay higher for longer, and that inflation will stay higher for longer as well. So I think it's a combination of the macro first and foremost that's been driving this move up in yields. After that, you can point to a few other factors. I think the downgrade may be brought front and center to investors, the size of U.S. deficits that we're likely to see. I don't think the downgrade itself was the cause of yields rising, but maybe it brought more to attention the size of deficits we're likely to see. And, you know, that's another, you're getting to the deficits themselves, that's another factor that's likely led to an increase in yields, is that the market's going to have to digest a lot of supply that's coming on, given the size of the deficits the government's running at this stage. And finally, a more minor factor I point to is interest rate policy around the world. You know, the Bank of Japan loosened up the yield curve control policy that they had in place, and that's going to shift some demand for U.S. bonds back into Japan. So putting all of that together, it's not that surprising that you've seen such a pickup in yields, but I really think first and foremost, it's the macro that's driving it. It's the strength of the U.S. economy. It's the potential for higher for longer.
I take your point, Robert, but let me get Steve in. Steve, you know, the FOMC minutes was the last in the list. Yields had risen even before the minutes, and they rose sharply because of the Fitch downgrade, highlighting the very large US deficit for at least 2-3 years to come. So now, even if the Fed doesn't hike rates, are yields likely to remain high because of this US fiscal deficit and bond oversupply?
I think it's possible, and you have to be, you know, properly humble about the ability to future on this. I think that the U.S. economy is slowing, and I think that when that evidence becomes more concrete, we will see some downward pressure on long-term yields. I think the inflation numbers are going to be, you know, very low for the next couple of months. It will take the pressure off of the Fed around making. So I think in the very short term, this feels very much like a momentum trend. When I talk to my traders, the sense I get is that it's short-term traders, people who follow short-term models, that they are the biggest drivers of this. When that can turn around pretty quickly. So even though there's nothing that's immediately visible in the future to reverse this trend, I'd say, you know, I'm more optimistic that maybe we'll see some downside to U.S. yields in the coming months. Not huge, but some. Then that it will keep on rising.
Okay, so you do see some downsides to US yields, but you're predicating that on lower inflation. But is Robert agreeable on that? Robert, what's your estimate of inflation in the US? And do you think the Fed is maximum one and done? Or may it go even higher?
these are the central questions right now. Right now, starting with the Fed, we think they're likely to pause at their next meeting. I think at Jackson Hole, Powell is going to strike a balanced tone where he's going to emphasize that they're data dependent. It's uncertain how far they're going to have to go. But wherever they stop, that rates are likely going to have to stay high for a longer period of time. So I think he'll sound very similar to how he sounded in recent weeks. But we think eventually it's going to spell one more rate hike for the Fed in November, given that we think it's going to take a while for that services inflation to come down in the U.S. economy. We're seeing a lot of improvement on the goods side. I think that's likely to continue. That's both on the food and energy side, but also core goods side. But it's that non-shelter services inflation that's likely to remain sticky as long as the labor market remains as tight as it is, and it's probably going to take a while to come down. So I think we have one more for the Fed. I think it's possible that if inflation proves even stickier and activity continues to be as strong as it is, that you could see the Fed go even higher from there. It's very hard to pin down, I think, the terminal rate once you're close to the end of the cycle within 25 to 50 basis points. But I do think wherever they end up, I think that it's going to take a while for inflation to come down, and so the bar for rate cuts is very high. So wherever they end up, I think it's going to be higher for longer from wherever they stop.
Okay. All right. Steve, what's your sense? You are expecting yields to come lower. What's your range for the 10-year for the rest of the year? Does it go below 4?
Yeah, that's a very tough question because to my mind, it's a question of market momentum, which is clearly to the upside. And certainly, from a trading viewpoint, no dividend yield since the last very long. So the inclination among traders is to, and anytime yields go down, to sort of short bonds and drive it right back up again. But I think the fundamentals are actually for yields to be somewhat lower, to go somewhat lower, at least for a while, than where they are now. I don't think. I think the market has backed away too far from the idea that the economy is slowing down. I think it's hard to clear that the economy is slowing down. And, I agree. I think this was right to downgrade in the U.S., but I don't think it's an immediate issue in terms of, any sort of risk on the U.S. side. So my suspicion is that trading can go up any day of the week, but that ultimately there are gravitational forces that will pull yields back down, probably below 4%.
Oh, probably below 4%. Okay, Robert, you're less sanguine about inflation coming down, but do you think China will be a disinflationary force?
Yeah, that's a great question. And, China's been one of, at least from my perspective, one of the more surprising elements within the global economy this year. We had a very strong forecast for China several months ago of around 6%. And then the data have just been coming in across the board a week, including on the inflation side where inflation pressures are extremely muted. And unlike other parts of the world, China's running the risk of too little instead of too much inflation. So I do think that's a risk. I think I would highlight two factors there. One, I think the amount of inflation that China exports to the rest of the world, so to speak, is a relatively small factor of what would be driving global inflation right now. And so I don't think at the margin it's going to be enough of a force to drive a big disinflationary process, particularly as I noted that a lot of the inflation we're seeing in major economies is domestically driven, is driven by services prices, which are going to be less influenced by global factors. The second factor I would highlight is we are at a moment where I do think the risks to China's outlook are to the downside, But we are seeing a fair amount of stimulus talk coming out of the government. We've seen some measures already from the Chinese government in terms of rate cuts. I expect more measures to come in coming weeks. So we haven't moved down our forecast from that 5% level. We still expect the government will be able to hit its target. And if growth comes even weaker, I think they'll just ratchet up the stimulus even more until they hit that target. So I think at the end of the day, China's not going to be as strong as we thought earlier this year. But I also think there's a floor on where growth's going to be. And it's not going to be as weak as a lot of the pessimists are thinking.
Okay. Nevertheless, if you see from May onwards, the yuan has depreciated so much. Steve, what's your sense? Does it depreciate even more?
I don't think it's being encouraged. I don't think that the external side of China is kind of either the problem or the rescue of the Chinese economy. I think it's a question of domestic demand and domestic confidence. There's nothing to stop it from going further. I think that there are some, perhaps some issues with Chinese firms with dollar debt that there might be some reason for policymakers to be conservative over the past. On the whole, I don't think that that's going to be. I think that the weakness of the currency reflects the weakness, domestically within China. It's not, it's an indicator. It's not a cause, and it's not the key force there. But I think that if we see any sign of Chinese rebound, the currency will strengthen and move much closer to 7. I think that the market is sort of waiting to see both the policy measures and the effectiveness of those measures before really going out and buying CNH or CNY.
If they go on cutting rates, naturally it's going to impact the currency, and they have cut rates even today, albeit not as much as the market expected. But Steve, some in India believe that since India has a large deficit, trade deficit with China, the Reserve Bank will allow the rupee to depreciate to keep pace with the fall of the yuan so that our deficit doesn't increase. So do you see more weakness in the rupee?
Well, I say that you look across Asia, every currency. So I don't think that there's anything particularly weak about the way the rupee is traded. I mean, it did break 83, but it's not that much higher than the top of the ranges that we've seen over the last year. Again, I think sometimes we talk about the currency, but I don't think that the fate of the economy depends on it. But China has such a big presence in Asia. It's hard to see other currencies rallying a lot if China is weak. So I think, again, I don't think that rupee will necessarily weaken a lot, but I think that it's, if you're looking for a big rally, if China, CNH is weakening, continues to weaken, it's going to be hard to tell the rally story, not just for the rupee, but for.
Yes, take your point. China is such a big factor that if China is depreciating, it's difficult to see other currencies rallying. Not that India wants the rupee to rally. Robert Sawkins, Steve Englander, once again, thank you very much for staying up for us on a Sunday night. They're joining us from New York. We have to wrap up on the note that the equity markets are still flat, but the mid-caps are up and away. On that note, it's a break and we hand it over to Chartbust.